Welcome to Breaking News to Trading Moves. Our mission here is pretty structured. We take the material you provide us, the market signals, the research, and we explore the key outcomes and implications across financial markets. The goal is to give you a clear look at the headline, define who benefits, and, well, identify which companies might face some new challenges because of it. Today, we're focusing on a recently completed transaction in the regional banking sector. It's Commerce Bank shares, ticker CBSH, finalizing its acquisition of FineMark. And this is more than just a minor announcement. It really provides a playbook for how regional banks are trying to stabilize their earnings and, position themselves for what's coming next. We're going to examine the facts of the transaction, and then we'll methodically analyze the winners and losers across the entire financial services ecosystem. So that's competing banks, tech providers, all of it.
Right. Let's start with that foundation, the hard facts of the transaction itself. So Commerce Bank shares CBSH has officially closed its acquisition of FineMark. And it's important to look at the structure of the deal here. It was an all-stock acquisition.
Okay. And in this current banking environment, that's a deliberate choice, right?
That's a very deliberate choice. An all-stock structure is highly favored by acquiring banks right now. It lets Commerce Bank shares conserve its cash and its regulatory capital.
So they're basically using their own equity as currency.
Exactly. Analysts often see that as positive because it minimizes any immediate strain on the balance sheet. So the direct functional outcome here is a targeted expansion of Commerce Bankshares' entire private banking and wealth management platform.
This wasn't just about adding a few branches then.
Not at all. This was a strategic move to acquire a complete established service line, one that's deeply focused on affluent clients who, demand specialized advice.
And to understand why they were willing to do this, we have to look at the geography involved.
That's the next key point. This deal immediately expands their physical presence into three very specific high-growth markets.
Which are?
Florida, Arizona, and South Carolina.
All Sun Belt states.
Exactly. And you have to ask, why are these three states so vital? They are all key destinations seeing, sustained population growth and, more to the point for private banking, wealth migration.
When people with money move, their banking relationships tend to follow them.
Precisely. By acquiring FineMark, Commerce Bankshares is essentially jumping ahead of the competition. They're meeting that capital where it's relocating, which makes these prime territories for this kind of high-touch private banking operation.
That focus on geography seems critical, but let's put some numbers on the change in scale. You said it's not just about total assets.
Right. To really appreciate the scale they've achieved, we need some context. If we look at the Pro-forma data, which combines the two, using figures from September 30, 2025, the estimated total asset size is around the $36 billion.
Which is a solid size for a regional bank.
It is. It provides efficiency gains and some regulatory stability, but for this transaction, that total asset number is almost secondary.
Okay, so what's the more relevant metric then?
It's the Pro-forma assets under administration, or AUA. The AUA figure is expected to reach approximately $90 billion after the FineMark deal.
$90 billion.
$90 billion. And that figure is the core driver of the strategic value here. That's what defines the competitive impact of the whole deal.
Because AUA is what generates the recurring fees.
Yes. AUA represents all the assets that FineMark clients have entrusted the firm to manage or advise on or provide custody for. And when you combine that scale, Commerce Bank shares immediately moves up the national ladder.
So where does that put them?
Post-acquisition, Commerce Bank shares now ranks 15th among all U.S. bank-managed trust companies.
15th in the nation. That's not just a vanity metric.
No, it implies that the bank has moved into a different competitive league, especially in its ability to service and attract ultra-high net worth clients who often look for that kind of institutional credibility. It changes how investment consultants and even regulators view them.
I imagine that kind of scale opens up doors that were previously closed, maybe new partnerships, institutional capital access.
It absolutely does. And it not only attracts more high net worth clients, but it can also subtly change who is willing to lend to Commerce Bank shares itself.
Also,
being seen as a top-tier player with a robust fee-generating wealth business can lead to a lower perceived risk profile. That could give them a lower cost of capital, better liquidity options. It's a material advantage in banking.
So what about the operational structure? Are they just absorbing the FineMark brand?
No, and that's a smart move. FineMark's brand equity in those growth markets is too valuable to just discard. So FineMark will now operate as FineMark Bank and Trust, but as a distinct division of Commerce Bank.
That lets them leverage the existing reputation and client base.
Right, especially in those new Sunbelt markets. It ensures client relationships are preserved during the whole integration process.
Speaking of integration, there's a timeline for that, I assume, and that's where the risk comes in.
A vital detail. The market is going to track this very closely. The necessary systems conversion and all the integration efforts are scheduled for the second half of 2026.
That's a ways out.
It is, and this timeline is critical. The integration window, usually around 12 to 24 months for a deal of this complexity, is where execution risk is at its highest. Banks can really struggle with merging core systems.
And that could lead to client disruptions or cost overruns.
Exactly. But it's also the period where all the projected efficiencies and cross-selling synergies are finally realized. If Commerce Bank shares can hit that 2H 2026 milestone smoothly, the market will reward them for it.
That gives us a really clear operational picture. So let's pivot a bit to the strategic context, because this transaction seems to signal what's driving M&A across the regional banking space.
Yeah.
You have to ask, why are banks paying a premium for wealth management and trust services right now? And I think it comes down to revenue stability, specifically fee-based revenue. Usually when we analyze a bank, we look at the net interest margin, the NIM.
The spread income.
Right, the difference between what they earn on loans and what they pay for deposits. It's the bread and butter of banking, but it's volatile.
Very volatile.
Wealth management and trust fees, on the other hand, are structurally different. They're based on assets under administration, regardless of where the Fed sets short-term rates. These fees are often described as stickier.
And that word stickier really means something. It means these revenues are just less sensitive to the economic cycle. When interest rates drop, NIM can contract very quickly.
But a wealth client isn't moving their entire advisory relationship because the Fed cuts rates by a quarter point.
No, that relationship can stay with an advisor or a bank for years, generating predictable, recurring fees based on the asset balance.
So adding $90 billion in AUA and a big affluent market presence, it helps stabilize and smooth out earnings. It provides a cushion against those fluctuating interest rate cycles, which gives the bank's earnings profile a resilience that a lending-only model just doesn't have.
And investors value that stability, especially when there's broader economic uncertainty.
It's a premium attribute.
And if we connect this deal to the broader market, this Commerce Bank shares FineMark transaction is highly consistent with a trend we're seeing across the entire regional banking landscape. This isn't a one-off deal.
Yeah, it's a pattern.
It's a strategic pattern. Regional banks are consistently pursuing M&A that's focused on acquiring fee-based growth, especially in wealth and trust services. The Commerce Bank shares acquisition is just a prime example of this strategy. And this pursuit of non-interest fee revenue is driven by a dual goal. It helps both the revenue side and the liability side of the balance sheet.
Okay, break that down for us.
First, the goal is to diversify revenue streams away from traditional lending margins. Relying only on NIM makes a bank a hostage to rate cycles and the health of the credit markets. They want more levers to pull.
And the second goal?
The second goal, and this has become very important in the post-2023 banking environment, is to defend deposits. High net worth clients who use wealth services also bring stable, large balance deposit accounts.
And those accounts are stickier, too. They're less likely to flee during market stress compared to, say, a commercial operating account.
Exactly. So acquiring these affluent clients is a strategic way to defend and strengthen the bank's liability base. In high-growth areas like the Sunbelt, the competition for stable capital is intense.
So this M&A isn't just about growth. It's also defensive.
It's also about preparing for future regulatory and liquidity challenges. It's building a more resilient balance sheet.
That reframes the whole thing. It's about building a fortress.
Okay, let's transition to analyzing the flow of capital and sentiment from this. We'll start with the winners. Category 1, the regional bank consolidators. The investment community tends to reward banks that show a proactive strategy of adding this kind of wealth and trust fee income while also achieving greater scale. It signals a commitment to stabilizing future earnings. And that positive sentiment gets amplified when the expansion is happening in these faster-growing regions like Florida and Arizona.
Right. So naturally, Commerce Bank shares itself, ticker CBSH, is the primary winner here. Successfully executing this kind of deal validates their long-term growth plan. Analysts will probably see improved revenue quality and a stronger defense against deposit volatility.
But it's not just CBSH. Other established players with similar strategies can also benefit from this thematic rotation of capital.
like PNC Financial Services, ticker PNC. They've long been a leader in emphasizing wealth management and diversifying revenue.
Right. PNC is almost the model for this. So when a peer like CBSH validates this path, investors often look at PNC as the proven example. Its diversified structure already earns it a relative valuation premium.
Another name that comes to mind is Huntington Bank Shares, ticker HBAN. They're also actively focused on optimizing their fee revenue mix.
Yes, and any success shown by peers, especially a clean acquisition like this one, just reinforces the valuation case for banks like HBAN that are pursuing wealth-focused growth. It tells the market that this is the correct trajectory.
So it lifts the boats of all the banks playing the same game.
It does. Now, let's move to category 2. This is the support ecosystem. The bank core and integration tech vendors. This is where the capital starts flowing right after a deal is announced.
Because an acquisition means a massive IT project.
A massive one. Merging two established banks with different systems requires substantial tech integration work, which means immediate and notable new spending by the acquiring bank.
And that integration window into the second half of 2026, that's when they're spending the money.
That's the intense period. For 18 to 24 months, the acquiring bank goes from being a standard tech consumer to a very active, high-spending purchaser of specialized services and software.
And where does that spending go specifically?
A few key areas. The biggest is the core system conversion. This is the complex process of moving all of FineMark's customer records, account details, transaction histories, all of it, onto Commerce Bankshares' core platform.
A very lucrative project for the vendors who do that.
Very. And hand in hand with that are large-scale data migration projects. You're not just moving data. It has to be cleansed, mapped correctly, and verified against strict regulatory standards.
What else?
We also see necessary investments in cybersecurity tooling. Merging two networks expands the attack surface, creates new vulnerabilities, so they have to invest in reinforcing network defenses, authentication, encryption.
And then there's the customer-facing side.
Yeah.
New digital onboarding processes.
Exactly. The combined entity needs to attract new wealth clients efficiently. So vendors who specialize in modern CRM and digital account opening solutions will benefit.
Finally, I'd guess compliance and regulatory tools.
You'd be right. As Commerce Bankshares expands its trust services and gets into that top 15 list, reporting requirements get more demanding. They'll need software upgrades to automate filings and ensure they meet heightened risk standards.
So let's name the companies that capitalize on this.
The first is Fiserv, ticker FI. Fiserv provides core processing systems, digital banking suites, payment solutions. They're fundamental to these operations and are often the destination platform for migrated data.
Okay.
Next is Fidelity National Information Services, ticker FIS. FIS is another major player in core systems, and crucially, the integration consulting expertise needed to merge these technologies. Mergers often mean lucrative one-time consulting revenue for them.
And the third?
Jack Henry & Associates, ticker JKHY, they're highly recognized for providing core solutions to community and regional banks. When an institution like Commerce scales up, JKHY is frequently involved in either facilitating the migration or acting as the new primary core provider.
So the tech backbone has to be completely rebuilt, and these are the companies that do the building.
Okay, final category of winners. Category 3, the brokerage and custody platforms.
This win comes a little further down the line once the unified wealth platform is up and running, right? Because the expansion of these bank wealth teams immediately results in more competition for advisor talent, especially in those Sunbelt markets.
Commerce Bankshares, with its $90 billion in AUA, is now aggressively looking to hire and retain advisory teams to manage and grow that asset base.
And as those teams expand and onboard new clients, they have to route all those client accounts and assets through established brokerage and custody systems.
Those systems are vital. They hold the securities, execute trades, provide research, manage the whole administrative backend. So this movement of assets directly boosts transaction and platform activity for the custodians.
And they generate recurring revenue from that.
Based on asset balances, transaction volume, and various service fees.
The primary company here has to be Charles Schwab, ticker SCHW.
Dominant force in custodial services for sure. Any expansion of bank-affiliated wealth management translates into potential asset growth and trading volume for Schwab's massive custody business.
Another key player is LPL Financial, ticker LPLA.
Right. LPLA operates a major independent broker-dealer platform, Bank wealth teams often leverage platforms like theirs to get more flexibility or access to a wider range of investment products.
And finally, we should include Bank of New York Mellon, ticker BK.
An absolute powerhouse in custody and asset servicing, especially for institutional clients. As Commerce Bank Shares expands its trust capabilities with that 90 billion AUA base, BK is a perennial recipient of those kinds of institutional asset flows.
Okay, that covers the winners. Now we have to look at the flip side, the groups that face new headwinds because of this deal. Let's start with Category 1, Sun Belt regional banks competing for affluent clients.
The creation of a stronger, more focused Commerce Bank Shares wealth platform in Florida, Arizona, and South Carolina immediately intensifies market competition. For regional lenders already there, this is a direct competitive pressure.
And that pressure shows up in a few key areas.
It does. First, competition for high net worth client relationships just gets tighter. A new, well-funded competitor means existing banks have to elevate their service level, which often requires more investment in staff and tech.
Second, I'd imagine there's increased rivalry in specialty lending.
Yes, wealth management relationships often lead to profitable lending products, securities-based lending, private banking credit lines. Commerce's entry means heightened competition for these loan books, which could compress margins.
And third, and this might be the most disruptive, is the competition for talent, the advisors themselves.
That's the immediate one. Top financial advisors are mobile. They follow the platform with the best resources and compensation. When a bank like Commerce Bank Shares gains this kind of scale, they become a more compelling destination, which drives up recruitment costs for everyone else.
So which banks are facing this direct challenge?
Western Alliance Bank Corporation, ticker WAL, comes to mind. They have a strong presence in high-growth markets, especially Arizona. They now face a reinforced competitor going after the exact same clients and talent.
Okay, who else?
Zion's Bank Corporation, ZION. They operate across several regional markets that will feel this new influence. Their private banking segments will need to sharpen their competitive edge against the newly scaled-up CBSH.
And one more.
Synovus Financial, ticker SNV. They operate heavily in the Southeast, so they're directly exposed to the increased rivalry in Florida and South Carolina, where Commerce has just expanded its focus.
So that's the on-the-ground pressure. But Category 2 is about a different challenge, investor preference. We're looking at rate-sensitive regional lenders with less fee diversification.
And this is a powerful force. The investment community has been very selective, rotating capital toward banks that successfully add these durable fee streams from wealth and trust services.
And that trend tends to depress the valuation multiples of banks that haven't kept pace.
Exactly. It makes lenders that are more heavily dependent on that traditional net interest margin look relatively less attractive. When Commerce Bank Shares executes a deal like this and adds $90 billion in stable AUA, the market immediately highlights the comparative weakness of less diversified peers.
And the companies we just mentioned in the last category, they face this pressure too.
It's a double whammy for them. They're dealing with competition on the ground and relative valuation pressures from the capital markets.
So Western Alliance, WAL, relies heavily on net interest margin. Even with strong operational growth, the lack of comparable fee diversification becomes a drag on its valuation compared to a CBSH or a PNC.
The same structural pressure applies to Zion's Bain Corporation, ZION. Their business model remains sensitive to rate movements and credit cycles. Investor preference for the fee-generating, more resilient model presents a consistent challenge for their valuation.
And finally, Synovus Financial, SNV. The market may increasingly scrutinize its reliance on NIM growth compared to consolidators who have a clear path to increasing revenue stability through fees.
It's not a judgment on their core banking business, but it is a reflection of the market's current preference for balance sheet resilience.
Okay, our final category of entities facing challenges is Category 3. Fintechs pushing into affluent banking and investing.
This deals with what happens when traditional financial institutions successfully modernize their offerings.
Fintechs usually gain market share by being a modern digital-first alternative to legacy banking.
Right. But when an established bank like Commerce Bank Shares upgrades its wealth offerings, broadens its product shelf, and layers human advisory expertise onto its digital channels, that creates new headwinds for fintech competitors.
Because for affluent clients, the value often rests on sophistication and trust, which a scaled bank platform is better equipped to deliver.
The institutional trust, paired with new digital tools, makes the traditional bank proposition much more compelling for these high-value clients. And this poses two main challenges for the fintechs.
Okay, what's the first one?
First, it can slow down their customer acquisition in the high balance segments. Affluent clients often look for the regulatory protection and complexity management that a top 15 trust company is seen as offering.
And the second challenge.
Critically, it may force fintechs to substantially increase their own marketing and customer acquisition costs to compete. If the customer is choosing between a newly upgraded bank platform and a pure digital offering, the fintech might have to spend a lot more on incentives or advertising to win that relationship.
Which directly hits their profitability models.
It does. We can look at a few examples. SoFi Technologies, ticker SOFI, aims to capture affluent, digitally savvy clients. The improved offerings from banks like the scaled CBSH make SoFi's pitch for being the primary financial institution more difficult.
What about Robinhood?
Robinhood Markets, HOOD, has been trying to attract investors with larger, long-term holdings. When regional banks become more capable in wealth management, it just raises the bar for competing platforms like Robinhood to prove they can handle complex wealth.
And finally, PayPal.
PayPal, PYPL, through its efforts to expand payment services into asset holding, also faces pressure. The strength of traditional banks makes it harder for payment and adjacent fintechs to move up the customer's balance sheet and become their central financial hub.
That is a remarkably detailed look at the flows from what is, on the surface, a single acquisition.
So before we conclude, let's bring it back to a forward-looking view. What should market participants be tracking?
For me, it's that integration timeline we talked about earlier, the second half of 2026. System conversions are where execution challenges really emerge.
Integrating two massive platforms, migrating all that data, harmonizing compliance, it requires immense coordination.
And failure at that stage can result in customer dissatisfaction, relationship loss, and a severe delay in realizing any of the merger benefits. If that 2H 2026 milestone passes without a smooth switch, the market will likely reassess the whole thing.
But on the other hand, that's also when the benefits start to materialize. The cost savings from eliminating redundant systems, the cross-selling opportunities.
Exactly. That's the point where the market stops valuing the deal on its strategic merits and starts judging it based on the tangible success of its execution.
A clear milestone to watch. And if M&A activity continues at this pace among regional banks, this strategic pursuit of the fee income land grab, so to speak, in wealth and trust could remain a measurable theme. It will influence capital deployment across the whole sector: banks, software providers, and platform companies.
It seems like a long-term driver of capital allocation.
For the foreseeable future, yes.
We remind you that this material is for informational purposes only. This discussion presents the opinion of the author of the material provided. This is not financial advice, and it should not be construed as a recommendation to buy or sell any security mentioned.